Retail investors are currently panic selling their crypto assets at a rate we have not seen since the FTX collapse of 2022. Right now, Bitcoin is trading around 64 to 67,000, and the fear in the market is palpable. We are watching Bitcoin dominance sit heavily around 58%, choking out the broader altcoin market, while Ethereum struggles below $2,000 and Solana retraces down to $70–$80 region. But while the average investor is searching for the exits, the on-chain data tells a completely different story. Today, I'm going to show you exactly what the institutional players are doing behind the scenes. We'll look at the internal market structure, the hidden accumulation patterns, and why the current panic might just be the greatest risk-adjusted setup we have seen in 14 months. If you value capital preservation and data over emotion, pay close attention to the metrics I'm about to share. The current macroeconomic environment is deceiving. If you only look at the red candles on your screen, it is incredibly easy to assume the market is dying. But price is only one part of the equation. We must look at the liquidity. Right now, stablecoin reserves sitting natively on cryptocurrency exchanges have reached an absolute all-time high of over $80 billion. That's $80 billion in pure purchasing power sitting on platforms just waiting to be deployed. Capital has not left the cryptocurrency ecosystem at all. It has simply rotated into cash equivalents to wait for a high probability entry point. When you have record high dry powder combined with capitulating prices, you have the exact conditions required for a massive supply shock. The institutional capital is not abandoning the asset class. It is patiently waiting for the weakest hands to fold. I'll show you how that supply shock is already beginning to form in the fundamental data in just a moment. Ethereum, despite its deflationary mechanics and robust smart contract ecosystem, is struggling near 2,000. Solana, a high-throughput network that recently saw immense transaction volume, has retraced down to sub-80. Yet the fundamental infrastructure supporting these assets continues to grow. Let us start with raw human emotion. If we look at the Crypto Fear and Greed Index, the metric has plunged into the single digits. We are currently sitting at a level below 10, representing a degree of fear that is mathematically lower than what we experienced during the pandemic crash of March 2020 and lower than the darkest days of the FTX collapse. To validate this extreme retail despair, we can look at raw search engine data. Google searches in the United States for the exact phrase "Bitcoin to zero" have just spiked to a record high. The last 2 times we saw this specific search term hit maximum standard deviation were perfectly aligned with the local macro bottoms in 2021 and 2022. When the average person types that into a search engine, they have usually already liquidated their spot positions in a panic. They are seeking emotional validation for their realized losses. When mainstream consensus universally expects an asset to fail completely, the marginal seller has already exited their position. There is simply no one left to sell. Retail capitulation is measurable, and we are staring right at it. But while retail is giving up, the entities with the most capital at risk are aggressively expanding. The Bitcoin hash rate has just snapped back in a sharp V-shaped recovery, crossing over 1 billion terahashes per second. Miners are the most capital-intensive operators in this industry. They are investing heavily in network security and computational power, completely ignoring the short-term price fluctuations. When network security scales while prices stagnate, it highlights heavy accumulation by institutional-grade entities. They are projecting confidence. This institutional confidence is directly translating into market absorption. For the first time in 3 months, Bitcoin's apparent demand has flipped positive. This is a critical leading indicator for any sophisticated investor. A shift into positive apparent demand means that mathematically, more supply is currently being absorbed from the market than is being issued by the miners. The structural groundwork for an upside price reversal is being laid right in front of us, block by block. And this accumulation is not just happening in Bitcoin. Sophisticated capital is actively seeking yield in decentralized finance, specifically looking for productive assets. If we examine the total value locked across the top 10 decentralized exchanges, we see massive, sustained capital retention. PancakeSwap has $4 billion in total value locked. Uniswap has $3.8 billion. Pendle, a protocol heavily focused on yield tokenization, has absorbed $2.1 billion. Despite the broad market panic, billions of dollars remain parked in these productive protocols. These investors are not fleeing to fiat. They are providing liquidity and compounding their yield while they wait for the macro cycle to turn. However, capital preservation means knowing what to avoid just as much as knowing what to buy. You must actively protect your portfolio from structural inflation. Take Arbitrum as a prime example. The vesting schedule for the Arbitrum token displays a severe, continuous upward slope that stretches deep into 2026 and 2027. This creates perpetual, guaranteed sell pressure from insiders and venture capital firms who are constantly unlocking new tokens. As an investor, you must aggressively filter out altcoin portfolios with these heavy vesting cliffs. No amount of network growth can outpace that level of sustained dilution. My strategy is to avoid these high-inflation tokens entirely and focus on assets with established scarcity and clear utility. Speaking of scarcity, I want to show you perhaps the most compelling chart of this entire cycle. If we strip away fiat currency debasement and price Bitcoin directly against gold, the relative strength index is currently at the lowest point in recorded history. Furthermore, this specific downtrend against gold has lasted exactly 14 months. If you study previous market cycles, the bear markets of 2014, 2018, and 2022 all lasted exactly 14 months. We are likely at the statistical tail end of a macro cycle, not the beginning of a new one. This historic correlation signals an impending generational rotation back into hard assets. So, how do we practically apply this data? We use the short-term holder realized price Z-score index. This metric measures the spent output profit ratio for short-term holders. Right now, it has plunged to -1 standard deviation. This explicitly tells us that short-term retail holders are panic selling and locking in severe losses. As a sophisticated investor, your job is to act as the counterparty to that panic. Buying in tranches when short-term holders capitulate at statistical extremes is one of the highest probability entry frameworks available in this market. Let us look at the current technical structure. Bitcoin recently experienced a 20% relief rally between $60,000 and $72,000, and volatility is now tightly compressing into an equilibrium, or was, as Bitcoin is now testing the critical $65,000 support level, with resistance sitting up at $71,000. This gives us a highly defined risk management framework. We position for upside continuation while using the $65,000 support line as a strict invalidation level for defensive structuring. If we lose that level definitively, I hedge. If we hold it, I compound. In my honest opinion based on this data, the underlying market structure is pointing to accumulation, masked perfectly by engineered retail panic. The combination of $80 billion in stablecoin dry powder, surging hash rates, and historic lows in the fear metrics leads to a massive impending supply shock. The smart money definitely buys when there is blood in the streets, even if it is their own. If you found this data valuable, please hit the like button and subscribe to the channel. For faster, daily updates on my personal market analysis, I invite you to join my free Telegram group. The link is pinned in the top comment below. Also, if you want to see exactly how I'm deploying capital into decentralized finance right now, go watch my latest video on my low-risk strategy for earning 25% yield on stablecoins. It's on the screen right now. As always, this is purely educational data and not financial advice. Thanks for watching. Protect your capital, manage your risk, and I'll see you in the next analysis.